Hello, my name is Dylan, and I will take the next few minutes to describe why Heineken NV should be sold. This analysis demonstrates one clear message. Heineken is a poorly managed company that is lagging behind its peers in a stagnant industry. The market seems to have blindly supported Heineken, putting momentum behind the stock, but this has started to slow, and as it does, operational quality will begin to rule. Heineken is a global beer manufacturer based in the Netherlands. While one of the world's largest brewers, Heineken operates in an industry that is currently experiencing major consolidation and which has little room for growth. Looking at the relative wealth chart, we first see that Heineken has been able to consistently generate returns in excess of cost of capital. This is a good sign for the company. However, it appears that the company is mismanaging these returns. A well-managed company will grow assets more quickly when returns are well above the discount rate, and more slowly in the worse years. With Heineken, there appears to be no correlation between returns and management's actions. In 2003, we see a massive asset growth with rather mediocre returns. This is followed by a sell-off of assets in 2004 with improved returns. We see the same thing happen in reverse during 2009 and 2010. Such dramatic mismanagement of assets is concerning. Sales growth appears to be relatively consistent up until 2008, where Heineken has begun a cycle of alternating high-low growth. The 2012 increase spike may be explained by the acquisitions made by Heineken that year. If this is discounted accordingly, we see a shockingly slow growth company in terms of sales over the past 3 years. Heineken has maintained mostly consistent margins over the past decade. While neither of these are necessarily concerning on their own, the peer comparison illustrates that Heineken's management is lagging behind. While the industry has been significantly improving margins over the past few years, Heineken has not. What also leads to some level of concern is the apparent disconnect between the industry and Heineken. In 2010, it played in their favor. Heineken sales grew substantially, the industry was stagnant. However, we see dramatic spikes in industry sales growth accompanied with much slower growth or even shrinking of Heineken sales repeatedly. If no other insights can be gleaned from this, it would suggest that Heineken is disjoint from the macroeconomic conditions within the industry. Heineken's stock price began to drift away from the hold warranted price in January 2015. For the past year, there has been relatively strong momentum driving the market price, while operational quality has not improved at all. We only need to view the market-implied CFROI to see just how overvalued the stock really is, and these projections will undoubtedly fall short. In an industry with slow growth and big players, you cannot afford to hold a stock of a poorly managed company. For that reason, Heineken is a must-sell.